Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website marketviews.tv. How are you doing today, Ike?
I'm doing well, Mike. How about yourself?
Oh, I'm doing good. Thanks for taking the time to talk with me and my listeners, because we've seen some very interesting moves, not just in the U.S. stock market, but the bond market, the U.S. dollar, and in gold. And I'm really interested to get your take on what's happening and where things could be going. We do periodic interviews during the year. And back in the beginning of the year, you gave us some potential scenarios for these markets. And some of them are really have played out going into really this fall. And now we're starting to see some shifts. So like to see what you think is happening now. And I got a link to your charts and the presentation on my website, Wall Street Window, with a blog post, so people can follow along there if they want to also.
Yeah, the link has actually the links back to the interviews that we did in January and May, and this way they can go back and read the entire thing. I have said in the past that different methodologies can be more or less effective depending on the market climate. For example, a methodology that is based on measuring volatility and taking positions about that is probably more effective during a market environment that is highly volatile. If you have an environment that has no volatility, that methodology won't be that effective during that period. It just so happens that the market environment that we have had the last year or so is conducive to the analysis that we do. Therefore, we have had a year that has been pretty good. Of course, I have to caution that just because we've been right, it doesn't mean we will continue to be right to the same degree going forward. Nevertheless, what is going on right now has a lot to do with what transpired throughout the year. So we're going to start from there, bring everybody up to speed, and then move forward. Back in January, and actually it was January 15th, we gave out the price targets for the year based upon the prevailing trend at the time, and also under the assumption that the yield on the 10-year bond would stay under 3.3%. That was a key assumption, and I'm going to go back to it later. At the time, I had said that the 2875, 2905 zone would be the first really important resistance for 2018, and probably an important turning point. The reason I said that had to do with the fact that many of the gains that we were seeing were coming from 40-50 stocks, and those were the 40-50 most active stocks in the OEX and the NDX. We use an indicator which is proprietary, and what it does, it actually analyzes the cash inflows and outflows for the 40 most active stocks on a daily basis for the OEX and the NDX combined. And when we did the interview, which was on the 15th of January, what we were seeing was a negative divergence that had started back in November. And I hypothesized at the time that at that rate, by the time we got to about 2875, then we would see an exhaustive point, which is exactly what happened. And after that, we had a very sharp decline. The next thing that I want to bring up is that I had said also that rates will rise to the top of their long-term channel, and more than likely they will break out and follow through about 4%. So I thought back in January that establishing an initial short position in the bond market would be a part or should be a part of someone's portfolio for 2018 and beyond. When we did that interview, the yield on the 10-year on the year
Hey,
bond, yeah,
you kind of I couldn't hear what you said right there. The connection cut out for a second though. When you're talking about you establishing a short position, after that it kind of cut out.
I'll start over. Also, on January 15th, another point that we made was that establishing a short position in the bond market was going to be a low risk trade for 2018. When we made that supposition, and that suggestion I should say, the 10-year bond, the yield on the 10-year bond was at 2.5%. As we speak right now, on October 19th, it's at 3.2. If you look at the ETF for the 10-year Treasury bond, the IEF, back then was at 103. It got as low as 99.5. So going forward, after having warned about an important turning point around 28.75, then the market turned down and made a low on February 9th at 25.32. Now we alerted our subscribers to expect a bottom around 25.25, 25.15. The bottom came in at 25.32, so we're off by 7 points. Then we proceeded to do an interview around mid-year. That was actually May 4th. And at that time, given what had transpired between January and May, we discussed 3 scenarios. And I said the 2 most probable were either the bull scenario, which meant we would have a breakout above the declining tops line that was established in January, and the market will rally up to about 2,900 and beyond. The second scenario would be the bullish breakout, or like we would get a break about 2,700, rally up to 2,800, and then fall. And the charts that we have in front of us are the 2 charts that we had posted back in May. The third chart below,
Well, that seems to be what's happening now.
that is exactly what happened. I mean, the chart as of October 18th, we see how the market broke out from the declining tops line had established in January and February, and then it rallied up to 2940. I want everybody to keep this picture because it is important. What we see in this chart, okay, is actually an upwards trending channel, which by itself is bullish. If you get everything else and just look at this, it could turn out to be a topping pattern, but to be a topping pattern, technically speaking, you will have to have a break below 2600. Right now, as we speak, the S&P has declined down to a little below the middle of the channel. That is normal. If we were to get a decline below 2600, this whole pattern would be negated. And that is very important to keep in mind going forward, okay? Now, the next thing I would like to talk about is this. In January, I had shown this chart. And what it is the yield on the 10-year bond versus the S&P 500. There was lots of talk about, well, rates are low, and in the past, we had to have rates rising about 5-6% in order to have a meaningful decline. My point was the data do not support that. The data the data support a different view, and that is we have seen significant market declines when the yield got up to the declining tops line. We saw that in 87,
Mm.
we saw that in 94, we saw that in 2000, and again in 2007. One thing that I want to point out is this. Both in 2000 and again in 2007, 2008, the rise up to the declining tops line came about 6-7 months before the market actually topped out. Okay, and we can see what I'm talking about right here. The rise up to the declining tops line in 2000 came, the market topped out in September. The same thing happened in 2007. The rise up to the declining tops line came in August. The market topped out in October. My point is that based on the evidence, it's not a hypothesis, it's based on what we see, it's based on the facts that we know from the past 30-some years. A rise up to the declining tops line has preceded a top in the market by about 6 months. So let's see where we are now. Back in January, what I pointed out was that the yield on the 10-year bond was dangerously moving up to that declining tops line. The demarcation point being 3.3%. And that is why I had said that the upside targets are valid as long as the yield on the 10-year bond stays below 3.3%. Look at the chart on the right. When did the market run into trouble? When the yield got close to 3%. We had the first decline last January, and again now with the yield around 3.2%. So the data, which is very recent, as recent as yesterday, validate the point that a rise up to the declining tops line in the 10-year bond, in the yield of the 10-year bond, will cause trouble to the market. The question is how lasting this trouble will be. All right? Now let's take a look.
Well,
Okay, go ahead.
oh, well, on yesterday on CNBC, I saw a fund manager make the comment that, and this is exactly what she said, that Jerome Powell is smart and he knows rising rates, if they go up too fast, would be a problem. And he's learned and he's smart, so this kind of stuff won't happen.
Well, the Fed has announced one more rise in interest rates in December and 3 more for 2019. If it followed through with that, then next year we're going to be well above 3.3%.
It'd be like 4, wouldn't it?
It'll be close to it, between 3.75
Yeah.
and 4. I think what the Fed is trying to do is move towards the neutral rate. The neutral rate is about 3%. Now, if you add about 1.5% on top of that, which is usually the market rate above the neutral rate, then we get to about 4.5%. The question is this enough to kill the bull market? Okay, I believe a rise above 3.3% is enough to give the market a serious jolt. And we have seen that already twice. We saw it in January, we saw it again last week. So what is interesting to me is as we rallied from the February low to the high a couple of weeks ago, what happened to the internals, which is the next set of charts I would like to talk about. The chart on the left is the cumulative new highs, new lows for the NYSE. Now we see that here I have two moving averages, the 50-day and the 200-day. Now this is an indicator that gives signals every few years. We can see it gave a buy signal in 2009, stayed above the 200-day moving average all the way up to 2011 when we got a sell signal. That signal preceded the decline we saw in 2011. We got a buy signal a few months later, and that signal stayed valid until, look at this, 2015. It stayed in effect for almost 4 years. We got a sell signal around the middle of the top in 2015, preceding the 2015-2016 decline, okay? And now we got another sell signal just a few days ago, right here.
And so people understand what if I understand correctly, this indicator is comparing the number of new highs being made with the number of new lows. So when it's
Well, actually what it is, Mike, it's the AD line for the new highs, new lows.
oh, okay, I see.
Okay? If you move to the chart to the right, which is since 2017, it's easier to see it. And what I want to focus on is this. Look, in January, the NYSE declined 1,353 points. You see that? During that time, the indicator lost 2,152 units from here to here. You move forward to the latest decline we had. The NYSE has lost 890 points. This decline, okay, is 34% smaller than this one, all right? Yet, the decline in the indicator is 83% bigger. This indicator has lost 3,928 points during the same time. So right here, we have a 1,300 point decline in price that produces a 2,000 unit decline in the indicator, okay? And right here, we have an 890 point decline in price that produces roughly a 4,000 decline in the indicator. My point is this: the latest decline has caused bigger deterioration in the internals than the one we saw in January, although in terms of price, the decline is much smaller.
Well, let me ask you this about that, which, you know, when the market fell in January, the VIX went up to over 40, and this time it didn't even go above 30. It doesn't seem, you know, even though these indicators have done this, it doesn't seem like there's been real panic in the market.
Well, the thing about the VIX, and I say this with lots of caution, is that I am not sure at this very point if the short-term fluctuations in the VIX really reflect what is going on in the market the way they used to 10 or 15 years ago, simply because 10, 15 years ago, you couldn't actually trade the VIX via ETFs, which you can now. So somebody being short the VIX via one of the ETFs, and then the VIX rising, trying to close the position, which then causes the VIX to rise even more, that creates distortions that we did not have 10, 15 years ago, or even 5 years ago. So that's why I'm more interested in looking at the weekly VIX and actually in looking at the higher lows and looking at the divergence of the VIX versus price. And I'm going to get to it in a little bit. because it's one of the things I also want to notice.
Okay.
I want people to notice, okay? Now, if we move to the next chart, okay, which is, again, new highs, new lows ratio. It's the chart on the left. What we see right here is a smaller, a bigger decline in price in January caused a smaller contraction in the indicator. Look at the contraction that we had during the latest decline, which is much bigger, although the decline in price is smaller than the one we had back in January. If you move over to the chart on the right, which is the McCall oscillator, again, look at what I want to do is compare the deteriorations that we have seen. The deterioration in January was much smaller compared to the one we had now, although the price decline was smaller. And then moving on to the last chart for this set, which is the VIX. You and I have spoken about the VIX many times the last few years, and I have always maintained the point that because of the ability to trade the VIX via ETFs, we are probably seeing distortions that we were not seeing 10 or 15 years ago. That's why I focus more on the divergences on a weekly basis. And I had pointed out several times that both in 2000 and again in 2007, 2008, on a weekly basis, we saw the VIX making higher lows, which is right here. We had not seen that for 11 years, and we saw it this last year. The last time we had the VIX making higher lows on a weekly basis was back in 2007 going into 2008. We saw the same thing this last 10 months. It doesn't mean it's going to continue, but it adds one more thing to the whole picture. And then the next two charts I would like to talk about is our inflows, outflows analysis. We have spoken about this in the past. These are proprietary indicators. Now, I posted a report on September 29th to our market business subscribers, in which I pointed out that the inflows outflows indicator, both on the 25 and 15-day basis, were showing divergence. That meant if the 2850 support level was broken, then we could easily go down to 2750 to 2700. And my assessment at the time was that with the S&P at 2900, there was a 100-point upside potential, a 150 to 200-point downside potential down to 2700. It just so happened that the S&P fell to 2700. Now, the point I would like to make, okay, is that on a 25, on the 50-day basis, okay, we see that we are right at equilibrium right here. Also, we can see the significant inflows into the market last year. Look how this indicator, okay, has stayed above the 50% for almost 1.5 years, okay? We did have this divergence, which in my view would cause trouble, and that's exactly what happened. But as we speak right now, right at the equilibrium point, which means right here things can go either way, okay?
Well, right now, I mean, at the moment, the market is right above the 200-day moving average. So it would seem like this is either the bottom or it's going to dump again, and the resolve, your indicators warning that, it would seem.
Well, Mike, if we look at the next two charts, the chart on the left, which is the monthly S&P going down, going back to 2009. The interesting thing to keep in mind is that we have a rising trend line, okay, that actually has support at 2,600. Okay, I mean the market could fall another 100 points from the 2,700 point low. Okay, and still it would be technically in an uptrend.
Okay.
So whether the market rallied for 2,700 or it fell to 26 and rallied from there, technically, for all intents and purposes, we're still in an uptrend. I mean, not because I said that, because the chart says that. Now moving to the left, to the right, which is the weekly chart. Again, I want to point out that the price action since January is a slightly rising channel, okay? And the bottom of the channel is around 2,600. So both on a monthly and a weekly basis, we have support around 2,600. So you cannot rule out a further decline down to 2,600 without that negating the uptrend. Given the positive seasonality that we have starting around mid-October until the end of the year, at this point, if we were to see a further rise, then perhaps this is it. A close below 2,700, to me, that would be a serious indication that we will test 26. The question is if it goes below 2,600. At this point, what I have to say is this. The deterioration that we have seen in the internals the last few weeks compared to the deterioration we saw early in the year, what it tells me is that the market internally is losing steam, but we can have anywhere between 3 to 6 months of upside action going into the second quarter of 2019 before we reach a final exhaustion point. So going forward, the first thing I would keep an eye on is the 2,600 level. If we break below that, simply means both the monthly and the weekly trend will have, the uptrend will have been violated, will have been negated. The deterioration we have seen so far suggests to me that it will be a problem for the market in the coming months, but not immediately. It's enough to cause further decline. It's not enough to terminate the bull market unless, and I'm going to repeat it again, unless we see a rise in rates for the 10-year bond above 3.3%. I think that can cause a more serious jolt to the market, like I said, since the beginning of the year. So basically, going forward, the two things I will pay attention to, again, would be the rate on the 10-year bond and whether the 2,700 level in the S&P holds, and more importantly, whether the 2,600 level in the S&P holds. If we don't see a violation of this support zone over the next 2 to 3 weeks and the market keeps going higher, then assuming the rate on the 10-year bond stays below 3.3%, the target we gave of 2985, 3005 with the S&P is still valid. But if it is achieved, it will be achieved even with further deterioration in the internals. So that tells me if late in the year or early next year, the S&P is at 3,000 and deterioration in the internals continues, that would be a good point to exit. So this is pretty much my view on equities right now. The two things to take away from what I'm saying is The last few weeks, we have had a smaller decline than the decline early in the year and a big deterioration in the internals. That may mean we have more downside to go on the short term, but more importantly, this is problematic for the market 3 to 6 months down the road. So that's my take on equities.
Yeah, it's almost like if you think of the big picture, it's not like we're buying stocks in 2009. It's like we're buying in 2007 at some point.
I think so too, or late 1999.
Right, right.
Anyway, next, of course, last but not least, is gold. Now, again, we have spoken twice this year about gold. Uh, Last January, January 15th, I pointed out that for the last 38 years, gold and the dollar have had a negative correlation. There has been a very short period of about 1.5 years during this 38-year period, like the two moved together, but there was only 1.5 years. So if the dollar and gold move together, or if you're betting on this, you're betting on something that is happening only 4% of the time. And that's reflected in the chart I posted last January and still valid. And the chart to the right is as of yesterday. Now, I had said back then that the dollar, okay, was coming to support, and gold was going to test resistance. And this is where the dollar was and where gold was when we did the interview. And this is what happened later. The dollar did come to support and bounced, and gold did go up to resistance and reversed. Okay?
Yep.
So now let's move on to the next chart. Okay. I had also pointed out that the dollar at that time when we spoke last January appeared to have formed a megaphone pattern. And that is the chart on the left. That is the chart we posted last January. And I had said that this pattern, once it's concluded, then it has one more failed rally up to about the middle of the pattern. And I had said if that happens, then we will see a rally up to about 96, 98, and then we'll see a failure. Okay? Well, let's move forward and see what happened 10 months later. This is what has happened now. We see we got a rally up to about 97. And the question is, are we going to see a further rally up here? Or actually that rally is going to be terminated in this area like usually the megaphone patterns end, okay? If that turns out to be the case, obviously I will be very bullish for gold. And we are in the area right now, okay, between 96 and 98 in the dollar index, where everything can turn upside down, okay? So moving on to the next set of charts is on August 24, which was just about 10 days after the bottom in gold. I pointed out something we have also pointed out the last year, and that is the chart on the left, the monthly chart, looks like an inverse head and shoulders. Now, usually the time between the left shoulder and the head and the time between the head and right shoulder is roughly equal. Now, from the right, if
symmetrical.
Yes. Now, if, and the emphasis is on if this turns out to be a valid inverse and inverse head and shoulders pattern, we see that from the left shoulder to the head, we had 34 months. From the head to the right shoulder, going out 34 months, That puts us around August of 2018. Now, usually when you talk about this time periods, I mean, we're not talking about days here or weeks, we're talking about months. You have to, add or subtract, a month and a half or so. So it could be 33 months, could be 35 months. Nevertheless, the point is, if this is a valid pattern, if this turns out to be an inverse head and shoulders pattern, and then you would expect the bottom to happen sometime between August and late October. Okay?
Let me ask you something about that. Just assuming for sake of argument, it is a valid pattern and gold is going to rally into the end of the year. What would that imply anything for interest rates in the dollar?
It would imply, as I said earlier, that the dollar will fail around 96, 98.
Right. Okay.
Okay. Like, look, if you look at the chart on the right, okay, we had two positives and two negatives at the bottom. Okay. First of all, we see that gold rallied up to 1350, which was the declining top line, and then it fell. That's where it turned down. Okay, and in that process, it violated the rising trend line. Okay, but at 1160, 1175 right here, okay, right here we have double support. This is the neckline. Okay, I'm sorry, this is um, the same level as was the left shoulder. I'm sorry, the neckline is here. And also, this is where the declining top line comes. And after they broke out, then it's very usual to get a decline back down to the breakout point. Okay, so right here we have double support. The point is, right here, both gold and the dollar could be at significant turning points. In fact, you may have seen the turning point in gold already. Last week, I sent out I posted our latest gold report in which I said that there are three scenarios going forward. The first scenario, which is the one on the left, is that gold consolidates between 1240 and 1210 over the next 1 to 3 weeks, and then it breaks to the upside. That can carry gold well up above 1300. The next scenario is that from January until now, what actually we have witnessed is an A, B, C, D, E type of decline. This is A, this is B, this is C, this is D, and E, which is the last wave down, is ahead of us. If that is the case, then gold will top out around 1240 and then decline below 1150. That is scenario two. In my view, these two scenarios are the two most probable going forward. And the last one, which is the least probable in my view, is that gold just goes sideways for the next 6, 8 weeks until the end of the year. I think, to me, looks the least probable. The two most probable is scenario one and scenario two. So either way, right here we're talking about a significant move. So, as you know, I don't have an ideology.
Well, it's also,
As you know, I don't have an ideology when it comes to investing. What I care is to be on the right side of the move. Okay. So right here, I think it requires attention because
well, it would seem, that possibly with the stock market also, the next, let's say 3 weeks are critical moments that will determine the rest of the year.
well, the chart suggests that. So I thought this was a good time to point all this out, and people need to pay attention, I think, to how markets behave over the next few weeks. And again, not because I say that, not because I think that, it's because the charts and the indicators say that. What I'm
Right.
doing is interpreting what I'm seeing. I'm not, making some sort of theoretical case here. I'm basing what I'm saying on the facts, the charts, and the indicators.
Oh no, this is one of the most interesting moments all year, really. And what's going to happen next? I've got my eyes glued on it, and I'm reading your updates myself. So it's. I'm glad you're able to do this interview with me, so we can get the information out to more people too.
My pleasure, Mike.
Well, before you go, uh, we were talking beforehand of doing a special to get people into your pay service so that they can get your updates in real time and not just a couple times a year when we're doing these interviews. Could you let people know what the service entails?
Well, the service entails two things. First is my own analysis, which people can see um, every 2 months approximately. We do an extensive report. Then every week we have our weekly reports, and in the middle of the week we have a shorter report. So we cover bi-weekly, weekly, and also like every month or 2 months, depending upon the market action. But I believe firmly that no one can be right 100% of the time. What is important is also to have a more rounded view. And that is why I have about 20 people, one of them is yourself, who I interview regularly, and they express their views, and their methodology is based on different tools than myself. For example, other people like Peter Lides, Jim Carrey, Stan Harley, for example, they use cycles. Jim Wells combines technicals and fundamentals. Harry Boxer focuses on momentum, high momentum stocks, just to use a few. So this way, people can get, as I said, a rounded view. And when you have 10, 15 people who have been in this business 25, 30, 40 years, there's a couple of been in business about 50, talk about something that perhaps I think you get a more informed opinion. So by joining market views, you will get my analysis, but also will get the analysis of another 20 some people who have been around for over 25, 30 years each. And one thing to keep in mind is that in this business, you cannot stay too long if you're wrong, because if you're wrong for too long, sooner or later you're going to run out of clients or money or both. So all these people who are contributing, having been in the business for 25, 30, I say some, couple, well, 50 years, probably they have been right most of the time. Not all the time, but most of the time. And I think given where the markets are right
Well,
now,
I find it interesting to listen to myself over. I mean, I've been listening for it's almost 20 years now, I think. But when you listen to the interviews on a regular basis of the same people, you see how they're adapting and interpreting the market over time too, and
well, there's
it's very
continuity.
interesting.
Continuity is important. It's one thing to hear somebody saying something, and another to know what he has said 6 months ago, a year ago, 2 years ago,
Hmm.
or 3 weeks ago, 6 weeks ago, 12 weeks ago.
That's right. And you can get a understanding of how their methodology works and so forth. And I think, doing this interview with you where we went back at the beginning and showed some of the things you were saying earlier in this year helps people understand that and what it is, the indicators that you're looking at and so forth. Well, thank you taking the time to talk with me and and we'll do more interviews as time goes on.
Thank you, Mike. Have a great weekend.
Thank you.